Clearly, the financial crisis is having a huge impact on communities, and I certainly anticipate that that impact is going to get greater and do more damage in many ways to communities. The reality is that we are, well over a year into this crisis, and although Congress and the President have taken some action of late, our worry is that really too late and perhaps too little. Cities are going to hurt. These are going to be very difficult times for cities. You might reasonably expect that the federal government would be in a position to step in and lend some assistance, but with the economic pressures being what they are and the promises that Congress and presidential candidates are making now, one questions again what will be available to help local and state government. Now, I happen to live in a state, Connecticut, the southwestern portion of which, Fairfield County, derives a lot of its strength from its proximity to New York City. Although 45,000 people come to Stamford to work from outside of Stamford, we do send about 12,000 people to work elsewhere, and a good percentage of those people are going to New York in the financial services arena or the legal or accounting arena, and in New York they tend to blend over or bleed over one another. So, we expect to see further serious job loss in Connecticut, either from employment in Connecticut or in New York City. The implications of which we're not really too sure of at the moment. Last week, the state controller estimated that Connecticut could be looking at an $800 million deficit by June 30th in the current year, and there is a structural deficit in next year's budget of $1.2 billion. Those are serious, amounts of money. And that, of course, could get substantially worse if income and capital gains tax revenues fall short of their diminished expectations at the moment. The credit markets are tight. I'm certainly happy that I don't have to raise money in the bond market at the moment, but at some point in the not too distant future, we'll have to go back to the bond market. And I certainly have heard of bond offerings being withdrawn and waiting for some stabilization in the marketplace. Over the weekend, we heard from California that they're unable to borrow money. Now, that may be made up for in short-term borrowings as opposed to long-term borrowings, and under federal statute, you can use those two things for periods of time to cover one another. So we'll see how that plays out, but none of it's good. I mean, the instability by definition is bad for the economy. And then, of course, the expected job loss and the increasing job loss that we can reasonably predict continuing for up to another year or longer is going to be difficult. We got to stop giving TVs away or money to buy TVs. We could chart our economy now and realize that we got about a 40-day, 45-day bump from the distribution of the lion's share of the last stimulus package. No money for infrastructure, no money for direct employment purposes. I believe that infrastructure is going to have to be, it should be part of a stimulus package if you want quick but also long-lasting impact. And of course, we should also talk about lengthening unemployment benefits and the like. The discussion that is being led by certain members of Congress, and Dodd is certainly one of those, about looking at infrastructure investment differently than the federal government currently examines it. Now, state and local government bond directly infrastructure investments. So we say if we're going to build a road system or a school or a water treatment plant, we're going to sell bonds and pay those bonds off somewhere between 10 and 30 years at whatever the going rate is for that the market dictates. That's very different than how the federal government does. Federal government treats all expenditures the same, whether they're for capital or operating expenses, and borrows for all of those projects at the same rate. and quite frankly, I think in some senses cost themselves more money than they might otherwise cost. I think clearly in a marketplace that is somewhat weary of the federal government operating on borrowed money, they certainly would understand borrowed money for infrastructure, and I suspect with the right language, you'd see rates decline on infrastructure investments, maybe go up on general government expenditures paid for by borrowing. But quite frankly, that might be a good thing in America as we reestablish some level of discipline with respect to taxation and spending policy. America needs to go to a system that treats infrastructure investment different than it does its constant and voracious appetite for borrowing for operational expenses, particularly as demonstrated under the 8 years of the Bush administration. Let us not forget that the Clinton administration, with all of its warts, we were operating on a surplus. And a surplus for the first time in many years. Now we just have Congress last week having authorized a debt up to $3.2 or $3.3 trillion. The lion's share of that is to cover operating expenses over the last 8 years. I mean, it's utterly ridiculous. So I do believe that the federal government should reshape how it expends its money and how it raises that money. And I think a capital account with different borrowings makes a lot of sense.